When you think about it, we are the product. I mean, the banks and Wall Street are charging us fees, interest, depreciation, lost opportunity. I mean, millions of dollars are leaving our families forever. I'm getting the hell out of here. So let's talk a little bit about that. Your 401k. It was designed to pay Wall Street first. They can take anywhere between 30 to 50% of your total gains. You take on all the risk and they get paid no matter what. And let's talk about the banks. Well, they make 5 to 25 times more than you do using your money, and then they pay you peanuts. Oh, and that house that you have, in the first 5 to 7 years, most of your mortgage payments are going to interest, 70 to 85%. They're not going to the principal of your house, and you don't even wanna know what those numbers add up to. How about your car? Your car is gonna depreciate faster than you're paying down the loan in most cases. In the bank, well, they always get paid first. And these are only a few examples of how we are the product. Well, it's not your fault. Let me give you a personal story. Up till 2014, I had a bunch of businesses, I had a bunch of real estate, and I had clients. Yet I still felt broke. So what is it that changed, right? What changed everything for me? Well, it wasn't me making more income. In the next 10 minutes, I'm gonna show you how. I'm gonna show you how I did it so that you can do it. And it starts with a strategy, a simple strategy that's been used by the wealthiest families throughout history. It's called the infinite banking concepts. And I'm gonna explain how to use your own private banking system and how to build real wealth, real financial freedom. So let's dive in. What you're going to do is you're gonna take from your income the amount that you wanna save. I gave you a target of 10%. And you're gonna change where that money goes first. And you're gonna put it into an account, not at a traditional bank, because a traditional bank will not be the best place for you to store money. Although you can use a traditional bank, it is not the most efficient place. What we have found to be the most efficient place, but not just us, the wealthiest families throughout history have found this, is giant mutually owned life insurance companies. And the only way to save money in a life insurance company is through a vehicle called a whole life insurance policy. That's right, but these whole life insurance policies are specially designed. They're specially designed to serve as a banking function. They do not work great as life insurance, although you'll always have a death benefit. They are not optimized for death benefit. They are optimized for max cash value. So now we changed one thing, and that is where your money goes first. Now let's apply everything else, because now we just covered the first two. You have an income and you're gonna save. And that savings is gonna go into a specially designed and engineered whole life insurance policy. And if you're asking why, I'm gonna skip past the why, and I'm gonna put a video up at the end, or you can watch the video in the bio that will show you exactly why we use specially designed and engineered whole life. So now let's keep going. We're gonna find an opportunity. And that opportunity is going to be a place where you can earn more money. Let's pick on debt. You have a Visa card. Now let's just say that Visa card is the smallest of all your credit cards. At $5,000 is what you owe Visa. Every month, you do your best and you pay $100 a month to Visa. That means $100 a month is leaving your family. And that represents a 25% interest rate. Why is this an opportunity? Well, here's why. You own the bank because you put the money in a specially designed whole life. So now your mindset needs to be shifted. This is not just a whole life insurance policy. This is your bank. Your savings is you capitalizing your bank so that you can run your own private banking system. And how you're going to do this is when you need money for an opportunity. And in this case, the opportunity is Visa. We're going to pay Visa off. That's your opportunity. What we're going to do is we're going to go to our bank and we are going to take a loan. Now, this might be confusing to some people because some of you are like, wait a second, I saved the money. It's my money. Why do I have to take a loan? Well, let me explain why we take a loan. Because if you owned a bank, like I explained, you would take a loan from your bank. So you do own a bank, and your bank pays you between 5 and 6+% on your money. Far better than what any traditional bank is paying right now. Not only that, because this bank is a life insurance policy designed properly, this money can grow tax-free. So now we've got a place where we're earning a higher interest rate and dividends in a tax-free environment. And if we want to continue to earn that higher interest rate, even when we use the money, we are going to take a loan. In other words, we're going to take a loan from the insurance company. The insurance company is going to give us that $5,000. The insurance company is going to charge us roughly about 5.2%. Today, the rates are between 5 and 7% depending on the interest rate. But let's keep this simple and just make it 5%. That's what the insurance company is going to charge you to use their money. But you're probably thinking, well, why would I use their money when I have the money in my whole life policy? I saved that money. Yeah, well, we still want to earn that interest rate and dividend on that money. So let's not take our money. Let's take the insurance company's money because they're gladly allowing us to take a loan from their general account up to the amount of the money that we have in cash value. So as long as you got $5,000 in cash value, you can take a loan of up to $5,000 because the insurance company wants collateral on the amount that they give you. So what's the collateral? Your cash value. And what does the insurance company actually lend you? Your death benefit. They will lend you part of your death benefit up to the amount that you have in cash value. Because remember, the cash value has to collateralize the loan. So by doing the loan, all of your money, all $5,000 or $5,000 plus dollars that you've saved in that whole life is still continually earning uninterrupted compounding interest. It is still growing at that interest and dividend rate that the insurance company paid you. They call it the dividend crediting rate. But now you have $5,000. So what you're going to do is you're going to take the $5,000 and we're going to come over here to Visa and we're going to say, Visa, we don't want you anymore. We're going to pay Visa off with the $5,000. Now, right out of the hole, that makes sense because Visa was charging you $25 and the insurance company charges you $5. So your spread, if you really wanted to look at that, your spread in this case is 20%. You pay the insurance company 5% on the $5,000 loan, but you were paying Visa 25% on that loan that you took from them, your credit card balance. So now that we paid Visa off, now we're going to move to the next part. You have to be consistent and persistent, and you have to be disciplined. Because you were disciplined in paying Visa every month. Visa sent you a statement or notified you when you were late, so you're like, oh my gosh, I got to make that payment. That payment was $100 a month. You no longer owe that to Visa because you paid Visa off using money from your banking system. So now what you're going to do is we are now going to be disciplined, and we're going to take the $100 that we used to give to Visa. Remember that $100 represented 25% APR. We're going to take that $100 and we're going to put that money back into your policy. So now every month you have $100 going back into your policy as a loan repayment. If you owned a bank and you took a car loan from your bank, you would pay your bank back. That's what we're doing. We're paying our bank back. But because you own the bank, every payment you make of $100 is $100 that you have back in your banking system. When you paid Visa $100 every month, did you have $100 back? No, you just owed $100 less. Over here, you physically have $100 that you can use the next day. But what we're also doing is every single payment we make back to the insurance company, we are repaying the death benefit. We are repaying the insurance company at the tune of $100. So the next month, you owe $4,900. And when you owe $4,900, that means that the insurance company is charging you 5% on $49, and then $48, and then $47, and then $46. You get the drift. If you're paying 5% on a declining balance, are you paying less in interest than you would have? Absolutely. But what also is happening? You got $5,000 over here in your cash value, adding $100 every single month in repayments. Plus you're still saving money, but the $5,000 that you had in cash value is compounding at a rate of over 5%. And it's not interrupted because you took the money, because you didn't take your money, you took the insurance company's money. This, my friends, is exactly what being your own bank looks like. The only thing that will change is the amount of money you have in the policy, but also your opportunity. Once you're done with all your debts, it will not be debts. Maybe it will be stocks. Maybe it will be private lending. Maybe it will be something else. But your opportunity will change. But every time you find an opportunity, just remember this simple rule. Whatever the opportunity's interest rate is, or potential interest rate is, needs to be higher than what your cost of funds are from your bank. Let me say that again. If your cost of funds from your bank is 5%, then your opportunity must warrant a higher interest rate or a higher yield than 5%. That's it. It's that simple. It's actually quite logical. Everything I just showed you is exactly what a bank does. We just reversed the order and made you the bank. Think about that. Every single thing we just did is what a bank does every day. The only difference is a traditional bank uses other people's deposits. Your private bank only uses your personal deposits, which come from your income. Hey, if this got your attention, go deeper. Scan that QR code and watch the full video right here. You see, it's time for you to take back control of your money, and it's time for you to be the bank. I'll see you on the next one.